Good morning, ladies and gentlemen, and welcome to the XPEDIATOR PLC Interim Results presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you the presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Danor Ionescu and Robert Ross, joint CEOs of XPEDIATOR PLC. Good morning.
Good morning, everybody.
Good morning. Good morning.
Good morning. It's Robert Ross here. I'll be doing the first few slides, and then Danor will take over, and we will hand over to each other as we talk through our various areas of responsibility. So welcome to our half-year results presentation. Just need to give you all the usual disclaimer. Those are our sort of standard disclaimer terms, not particularly easy to read. Anyway, we will sort of crack on with the agenda. So the sort of points we're looking to cover, an overview and COVID-19 update, the financial results, a business review and strategy update, and then a summary and outlook, and then the opportunity for the Q&A at the end. So in terms of our half-year results, we're very pleased with these results, a very resilient performance despite the impact of COVID-19. In terms of our sort of key metrics, those 5 we've got up there. So our turnover was down slightly. That's mainly, well, it's entirely due to COVID. In the first quarter of the year, we were actually ahead of where we were last year. Our adjusted profit before tax was up 5% to 2.1 million, driven by our freight forwarding division performing very well. Our adjusted operating profit was up 2% to 2.5 million. Our adjusted EPS was actually down for 2 reasons. Firstly, because we did a scrip dividend at the final stage earlier this year, which has increased the number of shares. But also our minority interest, the profit attributable to minority interest, has increased. And then our net cash is up to 4.3 million from the same period last year. So we feel we're well placed as we go into our traditionally stronger second half of the year. Over the last 4 years, on average, 60% of our full year profit has come in the second half of the year. Just in terms of our quickly on our business model, so we feel we have a scalable and risk adjusted platform. So that comes from our asset light structure, particularly in our freight forwarding business, which is the largest of our divisions. We don't run a large fleet of trucks and trailers, so to the extent that volumes decrease, as they did in April this year, we don't have a fleet of vehicles standing not working. We have a global supply chain solution for both the UK and our European markets. And our position is within the UK, but also across Europe, with the particular expertise in Central and Eastern Europe. So our key markets are Romania, Lithuania, Bulgaria, and Serbia. So we see our business model as having a very well diversified customer base. No customer is larger than 2% of our turnover, and across a multitude of different sectors. We're a cash generative business. We have a strong balance sheet. We have net cash, as I said on the previous page, and we have a very significant customer base, so 14,000 customers. We're really a portfolio of freight management companies, so covering a variety of different services, which includes customs clearance, which we'll touch on later. But we offer complementary services to our customers, so we can really take them from their point of manufacturing, whether in the Far East or Eastern Europe, perhaps, all the way through to their customer. I'll now hand over to Danor very quickly.
Right. Thank you, Robert. COVID came unexpectedly for all of us, but overall, leaving aside the short-term impact we saw in some of our trading areas, we think it made us a stronger business in the long term. Immediately, as we saw what was happening, we sought to understand and respond to our client needs. We started the dialogue. We set up situational command cells in each business unit that were coordinated centrally to see how we can engage with the clients, how we protect our employees, and how we protect the business overall. The pandemic also enforced and accelerated actually a critical review of our business, which we started at the end of 19 and we continued into 2020, looking at the costs and the cost structure, and that gave us a saving of $500,000, which will become an annualized saving. Strong performance in freight forwarding, particularly in Central and Eastern Europe, which fared better. It went early into the COVID lockdown, but it came out earlier than UK, and we saw good recovery and resilience in that activity. Transport solutions and logistics were both impacted, and we saw a decrease in revenue in transport solutions due to less traffic, lockdown in Europe, and also a reduced diesel price at the pump. And also in logistics and warehousing, there was an impact from retail clients, particularly fashion retail. We remain mindful of what is to follow, possibly a second wave, but we took steps to strengthen the business lines that have been affected and under pressure, and we are confident in the model that we will deliver similarly with last year and or slightly ahead.
Okay, thank you, Tino.
I'll hand over to Robert for financial results now. Thank you.
Thanks, Tino. Yeah, so on this financial highlights page, these are our sort of key 6 metrics that we see that we're looking to now report on each sort of 6 monthly basis. So as I touched on previously, our turnover was down slightly. Our pre-tax profit was up and reflects a really resilient first half performance for us. A slightly lower EPS. We have net cash, as I said before, at the 30th of June of 4.3 million. This compares to the year end of 7 million. So we're down against that position, but we have paid 3.7 million in deferred consideration payments for acquisitions that were made in 2018. We remain a cash generative business, and our cash generated from operations was good at 5.4 million. And we've got a 60% increase in our dividend at the interim, so 0.45 pence per share, which is up from 0.28 pence per share in the first half of the year. Just to touch on the deferred consideration, our final deferred consideration from those acquisitions, and this is there'll be no more after this, is around 650,000 to be paid in the second half of the year. Just moving to those actual sort of financial statements, just draw your attention to the increase in our gross profit in sort of year-on-year basis. We're up at 24.8% versus 24.2% last year, and then also our adjusted operating profit before tax of 2.1 million. In terms of the adjustments, so we've got some adjustments between the reported pre-tax profit and adjusted pre-tax profit. The exceptional items are mainly for redundancies and payments in lieu of notice, so we don't expect those to recur. As Denor mentioned, we've looked at the cost base, we've looked to rationalise that cost base, particularly in the centre of the business. Our IT, we were running very hard, particularly last year, to try and increase our profitability. To increase our digitalisation. And we're now just looking to sort of pare that back slightly. I'm keen to keep expanding our IT, to keep moving towards a digitalised position, but just at a slightly steadier pace. I felt we were running almost too hard on that. We've got some deferred consideration unwind and also amortization of intangible assets. And then also we try to flatten out the interest charge through IFRS 16, which is that final adjustment there. In terms of our sort of free cash flow and net debt reconciliation, just to point out the net cash generated from operations, and we've got the deferred consideration paid. We are a cash generative business and in a good shape from a financial perspective. Just moving on to the business review and strategy. Tanor, this is one for you.
Yeah. Thank you, Rob. So the group we structured, as you know, in three service divisions: freight forwarding, the largest, warehousing, and transport solutions. This gave us a diversity of businesses, which ensured our resilient behavior performance during this period. As you can see, revenue comes from 60% from Central and Eastern Europe and 40% in UK. It's a good spread of customers across this footprint, and we are looking to change or engage with the clients. We set up a customer experience program, which proved very useful during the COVID, where we stayed in contact with the clients. Clients have visibility of our services, have a track and trace facility, have a driver app. They see delivery as it happens, and they have a tracking facility. It's good performance, we believe, half year 2020 versus the first half of 2019, and we will continue to enlarge our customer base with focus on sales and customer service. We have new dashboards that measure the KPI, we call them CPI, Consumer Performance Indicators, and it gives us a feel of how we're performing against our customers' expectations. I'm going to move to the next slide. Now, strategy overview. Of course, we remain focused on developing the core service proposition, which is freight forwarding and logistics, and that proved resilient during this period, with freight forwarding in Central and Eastern Europe performing very well and showing even an increase despite the COVID. Also, both divisions came back very quickly to almost normal volumes from before the COVID situation. This generates a strong cash position with operating margins. We monitor, we manage the operating margin, and we have targets by business, by entity to improve those. Also, a focus on cash collection, trade receivables in the market. That was key, and it ensured our strong cash position at the end of H1. Technology, we continued with the investment in technology. We had a ramp up of investment in 2019 because we had to get up to speed on that. We are now approaching a new phase where we looking at investment in technology in a more steady and sustained way, and that is driven by a new IT director which joined us this month. Underperforming businesses, there are some areas which need attention. They've been under attention and support for a while, but COVID also underlined certain aspects that we need to address, so they continue to be under review. Customer-centric focus in sales and client service, I spoke about that. We have a program, a customer experience program, which looks at how we understand the client needs, how we approach that in a coordinated sales effort, how we measure our performance in terms of client service with dashboards, how we engage regularly in customer reviews, and so on. That gave us a good feel about how we're doing as a business, how we are reacting or meeting our client needs, and that will ensure our good performance further on. Acquisitions remain also a focus along with continued organic growth, and there is a healthy pipeline of acquisitions that we are looking at. Further cost savings to come from integration. So integration in UK of the new businesses in the group continues, and there are more synergies to come out of that integration process. Thank you for this. Robert, back to you, I think now, yes?
Yep, thanks, Anot. Yeah, so in terms of our freight forwarding division, some pretty significant growth between the first half of last year and the first half of this year. So quite a few things driving that. So within our e-commerce subdivision of freight forwarding, there are 3 business units, one which we've closed. The person that was running that has left, and so we've taken the view to stop doing that. It was losing money, and so we're no longer carrying on with it. Our eShop WeDrop business lost money in the first half of last year. Those losses have narrowed this year with greater focus on cost. And then our Regional Express business, which has the customs brokerage contract with Amazon, those volumes are improving now. And so there's been a sort of 200,000 year-on-year improvement from the e-commerce business. Our largest markets in Central and Eastern Europe, Lithuania and Bulgaria, have both performed extremely strongly. They had some good contracts coming out of 2019, which continued into the first quarter. And they've also bought and sold very well during the COVID period. Our Estonia and Serbian markets have matured during the first half of this year. They didn't make much money in the first half of last year, but are now making good levels of profit. And then in the UK, our freight forwarding business has some exposure to China and also to Italy. So that did have some negative impact with the COVID impact. But it's come back strongly from those positions in sort of April time. And our domestic business grew well in the first half of this year. So a very good first half of the freight forwarding division. It's our largest division. It's performed very well. We've got a number of strategic advances with that. We've got a new cross-dock facility in Lithuania. We are getting ready for Brexit, which we'll touch on in more detail later. We're very pleased with how that freight forwarding division has performed during the first half.
Right. Warehousing and logistics, they were impacted during the COVID. We saw a reduction in high street volumes. We saw a reduction in other client volumes, both in UK and in Central and Eastern Europe. Still, we believe there was strong performance because the impact of the COVID and the lockdown was compensated by cost control measures. We were able to furlough people. We were able to take other cost control steps. We approached suppliers like transport companies, landlords to get a reduction in rent, and we managed to keep the cost base under control. Alex continued to deliver very good performance during the period, as well as Romanian logistics. In UK, we continued with online clients, e-fulfillment for online businesses, and that proved a very good part of the business, both in UK and Central and Eastern Europe. Easy managed transport with a focus on high street fashion volumes saw the largest impact, as well as import services, which saw in Southampton reduced import volumes from China. This happened during April, May, and part of June. We continue with investment in digital experience, engaging with the clients. We are working to bring online a new warehouse in Southampton in first quarter of 21. The Braintree warehouse to attract more online fulfillment for retailers, and fairly confident that H2 will deliver an uplift on H1, but also in line with expectations. That's it for me on this slide, Robert.
Thanks a lot. Yep. So the Transport Solutions division is really a one-stop shop for hauliers. So allows you to get fuel card, ferry crossings, insurance, leasing, whatever a haulage company needs. Particularly, almost entirely Eastern European hauliers. So the revenue in the first half of the year was impacted significantly, as was the operating profit from the overall reductions in traffic volumes, but also in the fuel price as well. So January and February started strongly for the Affinity business. Gross billings were ahead of last year, but then decreased significantly in the second quarter. And this was seen across all of Europe. The fuel cards we provide the hauliers with are from DKV, and the volume reductions that we saw in Affinity were reflected across the whole of Europe, so 40% down in April time. This wasn't helped by a number of governments choosing to close their borders, which created long delays. But we did have the advantage that we then knew which hauliers were running, so we were able to leverage that knowledge across the business. So in terms of our strategic progress with Affinity, so volumes in June were much better, only 20% down, July 10% down, and now much closer to the pre-COVID levels. We expect the second half of the year to be positive. As mentioned there, the success in sharing the intelligence that Affinity had with the rest of the business was very helpful during the COVID period. So just touching on Brexit, which is obviously coming back into the news now that the COVID period is dying down. So we're very much focused on positioning the business to support all of our customers throughout the Brexit period as we go into what will be next year. We have several significant customs clearance opportunities. We see it as a net positive impact for the business. We have customs clearance staff in the UK and Romania. So the team in Romania, that will be very helpful from a cost perspective. We have a customs clearance control tower to manage and process those formalities. ETFS and AEO certifications are held within the group and a number of companies. And we have a close relationship with HMRC and our industry associations. So overall, we see it as a positive impact for the group. We're fortunate that 60% of our business is within Europe already, and there's only that balance either just within the UK or between the UK and Europe. So whilst there will be an impact for us from that, it won't be as significant as some other businesses that are entirely focused on UK European road freight. Just to summarise then, so from our perspective, we're very pleased with the first half performance, a very resilient performance. We're focusing on our core services of the business. As I say, we've closed one of the areas which was slightly different in the e-commerce part of the business. We have a good mix of geographies, a good mix of services, which gives quite a unique combination, we believe, and we're very confident in future demand for our products and services. We are very focused, though, on having the right growth disciplines, the right infrastructure, and most importantly, because we are a people business, the right personnel to support our profitable expansion. We continue to look at acquisitions, but we'll look at them on a much more strategic basis, where they add additional services to the business or additional markets. And as I said previously, we have a strong second half weighting. So we feel we're very well positioned to tackle the future uncertainty that we're all facing, and also to deliver a strong result for financial year 2020.
That's fantastic. Daniel, Robert, thank you very much for updating investors today. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. I'm sure the company take a few moments to review the investor questions. I would like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on Investor Meet Company. Lastly, before I hand back to Daniel and Robert, I would like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Daniel, Robert, perhaps before we look at some of the questions we've had through, I could address some of the pre-submitted questions to you, if that's okay.
Yeah, sure, no problem.
Right, well, let's start with this one. It'll be, I guess you could touch on this slightly throughout the presentation. It'd be really helpful if you could break down each division and the different characteristics of each business and the revenue associated. Also, are there areas you'd look to expand into via acquisition?
Let me grab that one. So from I suppose we've touched on each of the divisions during the presentation, but just to go over those very quickly. So freight forwarding, which is our largest division, is about road freight, air freight, and sea freight. So moving goods from A to B. We don't run our own trucks and trailers. We use subcontractors. The largest part of our business is groupage, which is about consolidating smaller loads. It's the highest margin business compared to part loads or full loads. And it's an area that allows you to specialize in once you have significant volume. So you're gathering up goods, let's say in the UK, and then running daily services to Italy, for example, Germany, and then you have a partner in those countries which distributes the goods for you. So that's our largest division. And then the logistics and warehousing is, apart from the pallets division, the warehousing is goods coming in on pallets. We store it for people and then pick, pack, and then distribute to customers as required. And then, as I touched on in the presentation, the Affinity Transport Solutions, that's really a one-stop shop for hauliers, particularly smaller Eastern European hauliers. It gives them all the services they need in terms of the fuel card, the insurance, the ferry crossings, so they don't need to sort all those out themselves. Any other areas we're looking to expand into via acquisitions? I'd say from a geographical perspective, yes. From a product perspective, no. We're very keen to focus on our core products. It's not necessarily something that we have done previously, but those three divisions, very keen to focus on those, stick to what we're good at. We've got very good experience and knowledge within the group, and really keen to focus on those and expand from a geographical perspective. So maybe it's a company that's got operates in different geographies to us from one of our existing markets, or maybe it's in a market that we're not currently in. So there are areas in Central and Eastern Europe that we're keen to expand into, and also possibly into Western Europe, though we realise that those are much more challenging markets, being Germany and France and Spain, much more challenging. So we're likely to remain with our existing offering to those countries.
Fantastic. Thank you very much indeed. Next one we've got here, with no client representing more than 2% of your revenue, what are the risks to your business and the stability of the revenue typically that you have?
Yeah, probably one for me as well there. So yeah, we do have some exposure to retail, to the UK high street, particularly the UK business, and then in Central and Eastern Europe we have some exposure to the automotive sector. So yeah, when we do face some challenge from being exposed to those sectors, but they've been sectors that have been very successful for us. So the main risks for us are just reduced volumes around of trade around the UK and Europe. But that impacts almost every single business, really. Those are sort of major macroeconomic impacts. You know, we're relatively diverse in terms of our end user markets, in terms of our customer base. So we feel we're reasonably well, the risk reasonably well mitigated. In terms of sort of contractual business, we don't have a huge number of contracts. Some of our business, particularly the warehousing business, and some of the freight forwarding is contractual. But really, it's about recurring business with existing customers. A lot of it is spot business, but if you do, the analogy I've used previously is similar to a taxi company. You know, before the days of Uber, if your taxi driver was good, you continued using them, and if they let you down, you go somewhere else. So for us, it's really important to be not only competitive from a pricing perspective in freight forwarding, particularly, but also competitive from a quality perspective. So making sure the goods arrive on time, they've not been damaged, proof of delivery has been delivered, and what have you. So yeah, we're a very diversified business, and we face risks just like every business, but really ours are more macroeconomic rather than anything different.
Fantastic, thank you. And you know, a question that's popped up pre-submit and also in the live event, really just around what steps have you taken to address the upcoming border changes? I know you mentioned this and your operations within Europe. You know, Brexit's around the corner. Again, what does this mean for you? I guess something that's on investors' agenda there, just to really highlight that, please, if you could.
Yeah, I mean, it's for us that the benefit for us is that we're a much less structured business than others. So where I used to work previously, very structured trips into Europe. So delays in the border crossings would have an impact on the operating model. We're sort of less like that. We've got a more fluid, more flexible operating model. And we also use subcontractors, so we can flex our fleet size up and down. There will obviously be some challenges, particularly initially. We don't know what it's going to look like, but we do continue talking to HMRC. From our perspective, we don't necessarily see an increase in cost, but from a customer perspective, there will be an increase in cost. Customs clearance, it'll cost somewhere between 25 and 40 pounds for a clearance. So the key for us as a consolidator is to try and help our customers as much as possible to do consolidated clearances rather than individual clearances, which is why it's better to come to a consolidator like Xpediator rather than potentially just clearing 1 pallet, 2 pallets yourself. You can do a consolidated clearance. So there may well be cost increases for our customers, but from our perspective, we feel we're very well set up for it. We have good IT. We have a team in the UK and also in Romania that are highly experienced, and from a business perspective, actually see it as quite a significant revenue and profit generation as we move to customs clearance.
Perfect. Thank you very much indeed. Just a couple more, if I may, and then perhaps move on to some of the other live questions that we've had through. We've got one question here, really just sort of for you, what are the key points out of today's update? If you could just pick out your key points from your business perspective.
Yeah, I mean, for me, it's the resilience of our business model. Despite COVID, which has had a net negative impact on our business, we're in good shape. We've taken cost out. It may sound slightly counterintuitive, but actually COVID came at not a bad time for us. It allows us to sort of reset the business, allows us to have a close look at things. We're looking to integrate internally more ourselves across all the different markets. There is a digitalization project that is ongoing. We've sort of done a soft launch of it, our booking system in the UK, which will then be rolled out to other parts of the business. And as we grow, we won't need to add additional cost to our business. This is allowing customers to get a quote within the target's a minute. I think it's over a minute at the moment, but not by much. As the sort of system remembers collection and delivery addresses and what have you, it'll bring it down to a minute. So it's really will help drive cost out of the business. So those are our main sort of strategic objectives. Continue to look at the cost base, to keep being cash generative, to look after the customers, and just provide a high quality of service at as low a cost as possible.
That's great. Thank you very much. Another one here. Can you give some more color on which markets are good and bad for you? I guess you covered some of this off as far as the sectors, but if there's any more detail you can give investors, that'd be great.
Yeah, I mean, I can touch on that. I don't know if you want to add to this, but from my perspective, the UK is a very competitive market. All the big players are in the market. There are also lots and lots, very fragmented market, lots of smaller players as well. People effectively running a freight forwarding business from their bedroom. So very competitive, but a very good market because there's a lot of freight, and there's a lot of consumers, and it's a reasonably small market from a geographical perspective as well. So you can do a lot of distribution in a quick, short space of time. Denora, I don't know if you want to perhaps touch on the foreign markets.
Sorry, Rob, I just difficulty hearing, so my line is not very good.
Okay, no problem, Denora. Let me pick that up. So yeah, from our perspective as well, the Central and Eastern European markets are good ones to be in. They're growing much faster than the UK. 3, 4, 5% GDP growth every year. We see those as lots of opportunity there. We're looking to expand into other Central and Eastern European markets. but also keep our business between the UK and Central and Eastern Europe, and then those large Western European economies of Germany, Italy, France, Spain, and Portugal, I suppose, as well. So yeah, for us, there's lots and lots of opportunity across all the various markets.
That's great, thank you. Perhaps we could just turn to some of the live Q&A that's come through, if you wouldn't mind just having a scan through that. I know we've hit a couple of those points, and some of the questions we've had in as well, you've covered off in the presentation, but there's probably a few more there that you could have a little look at, if that's possible.
Yep. So I'll take this one from Martin H. So can you provide us, can you update us on the plan to get to the 500 million and £1 billion revenue, and what mix of debt versus equity we use to fund the expansion? So yeah, we obviously the COVID has slightly dented our organic growth this year, but we're still looking to get to be a £1 billion turnover business as quickly as we possibly can. So we're looking to continue to do acquisitions where possible. We would look to fund those with a mix of debt and equity. I don't necessarily know how we're going to how we'd fund that acquisition, debt versus equity, but we certainly need to have some debt in the business. I think it's important, particularly with how cheap money is at the moment. But also we'd look to raise money via the equity markets as well. For me, where there's a rationale for coming back to the market, we'd look to do that. I know the shareholders wouldn't look for us to raise equity with the share price at the moment. The share price is obviously lower than we would want it to be, lower than we feel it should be. But yeah, we wouldn't look to dilute people at the moment. So acquisitions that we're looking at are either debt funded or either with our existing facilities or leveraging the balance sheet of the acquisition. So still very much looking to get to that £1 billion revenue target. And we're certainly still looking at acquisitions, but just for me, just trying to be slightly more measured than perhaps we may have been in the past. And then the other one from Yi Hui W. So who are your main competitors in the markets you're operating in, and what are your competitive edge over them? So particularly in the UK, and I'll perhaps touch on this because it's where I have more knowledge. The way Denor and I have split the business is that Denor looks after the overseas entities predominantly, and I look after the UK entities. So in the UK, from a road freight perspective, our main competitors are sort of Kuehne+Nagel, DSV, DAXA. So your large pan-European businesses. So I'd say our competitive edge over them is our flexibility. Is as we move into a digitalized world, we would look to be very competitive with them there. But also our sort of customer service. You know, we're a small company relative to them, so we can really focus on our customers. But also our Eastern European, our exposure to Central and Eastern Europe. You know, we're highly competitive there. We've got very good quality services in Eastern Europe, and we feel we're sort of very competitive against them in those markets.
That's great. Thank you very much. I think Dano's just having a little issue with his telephone line coming.
Yeah, no problem. No, I'll just he'll owe me one after this. That's fine.
Yeah, absolutely. No, thank you, Robert. I think you have addressed a number of the questions that we have had through. Just seeing if there's any other ones that we've got through. I guess you've already covered that off. What are your strategic priorities for the business now? Pretty much you've given us the colour on that. So therefore, I think you have covered off pretty much everything that we've had through. Therefore, on that basis, perhaps I could just ask you to wrap up, Robert, before we redirect investors for feedback.
Yeah, no problem. Well, look, thank you all for joining. You know, we're very excited about XPEDIATOR. We think it's a fantastic business. We've performed very resiliently during the first half of the year, despite the negative COVID impact. We're now looking to continue into the second half of the year, which is the stronger part of the year for us. We've got exciting expansion plans in the business. We're ready for Brexit. We're ready for the challenges that are coming towards us, and we look forward to presenting some really solid results for 2020 into the early part of next year. So thank you very much for joining us.
That's great. Thank you very much indeed. And just a reminder to investors that all questions submitted today will be reviewed by the company. So thank you very much, Dan. And thank you, Robert, for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback. If you access this meeting via our website, the feedback page will appear. If you've accessed it via the link that we've sent you, you'll just be asked to log in. Therefore, on behalf of XPEDIATOR PLC and Investor Meet Company, thank you very much for attending today's presentation. That concludes today's event. Thank you.
Thank you very much.